Options Trading, the ultimate guide. How to trade and make money when we are in a bear market and a recession. David Jaffe with beststockstrategy.com, and in this video you are going to learn the best way to make money in the stock market in 2019 and when the market is moving sideways and when it's also going down like it has been over the past few months. So the first thing that you need to indoctrinate or to believe is that selling option premium gives you the best statistical odds of predictively making profits. As I've said on numerous occasions, I don't believe that day traders make money in real life. I know that that is very contentious, but as someone who's traded for 20 years and worked on Wall Street in some of the largest investment banks in the world, I can tell you that I have never met someone with verified performance who is extremely wealthy, who's a day trader. But in any case, from selling option premium, these are the steps that you have to take in order to be profitable in 2019. The first thing is you need a watch list of stocks. So I picked out a few stocks which are relatively recession proof. They are the following: Lockheed Martin, RTN, which is Raytheon, Boeing, McDonald's, DG, which is Dollar General, JP Morgan, and the fifth one, which is a little bit surprising, is actually Facebook. And the reason why I believe Facebook is a good opportunity is that Facebook, its 52-week high is around $218. Right now, it's trading in the low 140s. As a result, it's already fallen around 33%. So where is it going to fall? If it trades all the way down to 120, we can still make money by selling premium in Facebook. In fact, the implied volatility in Facebook right now is extremely high. So that's why I think that Facebook, even though it's not necessarily recession proof, I do think that it's a good trading opportunity, because how much further is it going to fall? Even if it falls down to like 110, we can still tread water and roll and manage that position, and over time have that become a profitable position even if it goes down. So the stocks, to recap: you have LMT, Lockheed Martin, which is trading, well actually I'll get into the trading ranges afterwards. BA, then you have MCD, DG, JP Morgan, and then Facebook. All right, so Lockheed Martin, I think it's trading at around 305. Raytheon is trading at about 180. Boeing is trading at around 350. McDonald's is around 185. DG is around 115. JP Morgan, I think, is around like 310, but I think it's out like 108. And Facebook is around 142. All right, so don't quote me on that. It's November 13th, but these are the approximate prices on each of them. Now, we also have different sectors represented. You have LMT, Raytheon, and Boeing. That's one sector. McDonald's, that's a second. Dollar General, that's a third. JP Morgan is finance, is fourth. And then Facebook is five. So you have 5 sectors here. That's pretty good diversification. And all of these are relatively recession proof. You have defense, which have predictable revenue streams with government contracts. You have McDonald's, which is a known recession proof because it serves cheap food. You have Dollar General, which is a dollar store, and all of these are market leaders. You have JP Morgan, which is a market leading largest finance company, and you have Facebook, which, granted, it's a tech stock which has been beaten down, but at the same time, it's already down 1/3 or 33%. So how much further is it going to go? So the next thing you want to do is very simple. You want to ignore everything. If Tesla falls $50 and you have motivation and incentive to sell a put, don't give in to temptation. Just ignore it. If Microsoft falls, or if something else falls, or even if Apple falls like it has this past week, don't give in to temptation. Just ignore it. Focus on these stocks. Notice how I rattled off the prices on these securities. I think there's like 8 securities here, or 7 of them. Notice how I rattled off the prices just off the top of my head. And granted, I'm sure that they're pretty accurate, the prices that I quoted out. The reason is that every single day I'm looking at these securities. and you will get familiar with their trading ranges. But the only way that you can do that is if you don't distract yourself with ancillary and competing information. So ignore everything else. The next thing that you do is you wait for the stock to fall on the low end of its range. Okay? So Lockheed Martin, the only way that I would sell a put in Lockheed Martin is if it fell to around 295, at which time I would sell the 270 put. Raytheon, if this fell to 175, I would then sell like the 165 put. Okay? Boeing, it fell a lot today. If this falls to 335, I'll then sell like the 305 put. McDonald's is actually trading near its high. For me to sell a put on McDonald's, it would have to trade all the way down to below 170, around 173, at which time I would say like the 164 put. DG is also trading relatively close to its high. I think its high is around 120. Currently it's at 115. If DG fell to 110, I would then sell the 100 put. JP Morgan is relatively consistent and it's relatively stable in its pricing. If it fell down to around 102, I would then sell like the 92 put. Facebook, if it fell down to around 138, which is a price that it hit around 2 weeks ago, then I would sell like the 128 put. Okay? So remember, we're waiting for all of these stocks to correct another 5% or so, and then we are selling a put around 10 to 15% below that depressed market price. But remember, it's a recession, and so it's a stagnant market, it's a bear market, so we are also going to sell calls, which is something that I've done a lot over the past month. But I don't lead in with selling calls. It's not my goal to sell calls unless I know for a fact that we are in a bear market. So what I'll do when we're in a sideways market like we are right now is I will opportunistically sell calls. A great example of this is on Boeing. So Boeing 2 weeks ago was trading at around 365. So I opportunistically sold a 400 call. Then I closed it out like a week later. McDonald's, I actually sold a call. I sold a 195 call. The reason is that McDonald's is trading near its 52-week range, and I sold a 195 call. Dollar General, same thing. When it was trading at around 118, I sold a 122 call. So you opportunistically look to sell calls, and that's actually the reason why I'm not a big fan of strangles. And this is a question that I get very frequently. Why don't I sell strangles? It doesn't decrease the buying power and it's more capital efficient. Yes, but I'm telling you that, remember this, okay? When you sell a strangle, that means that anytime you sell a put, it is not a good time to sell a call. So for example, the way that we trade, if Lockheed Martin is trading at 305 and then we wait for it to fall to 295 and then we sell a 270 put, you're gonna sell a call option if you're gonna put on a strangle when Lockheed Martin is trading at 295. But remember that Lockheed Martin's price is already depressed. So if you choose to sell a strangle, and if you wait to sell the put on Lockheed Martin when Lockheed is trading at 295 and then you would sell like the 270 put, what strike price are you going to select for the call? You're going to sell a 315 call? Great, but 315 call, in my opinion, that's very risky because Lockheed Martin is already overextended to the downside, and additionally, you will collect virtually no premium for selling that 315 call. So that's why I don't like putting on strangles. And I think that, well, actually I know that by using this method and waiting for a 305 Lockheed Martin, which is its current market price, by waiting for it to sell or to fall down to 295 and then selling the 270 put, you're actually collecting way more premium when Lockheed Martin trades down to 295, and just by selling this 270 put, you're collecting substantially more premium than if you sold a strangle on Lockheed Martin right now just because it has high implied volatility. Let that sink in. If Lockheed Martin falls down to 295 and you sell a 270 put, you would collect substantially more premium from selling that 270 put than you would if you sold a strangle on Lockheed Martin right now. And additionally, you are mitigating your risk by waiting for Lockheed Martin to fall down to 295 because therefore Lockheed Martin is already trading on the low end of its range. So that's why I am not a big fan of selling strangles. I am opportunistically a fan of selling strangles. So for example, in this example, if Lockheed Martin trades down to 295, you sell the 270 put. Then if Lockheed Martin increases back in price to about 310, I'm completely okay with you then selling the 325 call option to then turn that position into a strangle. I'm completely okay with that. Although in this scenario, you would probably close out the 270 put because you would ask yourself, would I make this trade again? And you probably would not trade and sell a 270 put when Lockheed Martin was trading a 310 because a lot of that premium is already sucked out of that trade. So that's why I believe that you should definitely sell calls, but you do it opportunistically. So back to these examples. I sold the call when DG was trading on the high end of its range, when it was trading around 118. I sold it at around a 122 call. JP Morgan, I haven't sold any calls, and Facebook, there's really been no opportunity because Facebook has pretty much been trading between like 140 and 155 for the past few months. So remember, in a bear market, in a stagnant market, you want to sell puts and you want to sell calls. And you also want to be very patient in your entry price. The other thing, and I know that I've been very, I've been against the idea of selling verticals, but remember, new market condition, new environment, my mind changes. And in this situation over the past month, I have been selling a lot more verticals. And the reason for that is I want to protect myself against the outsized moves, the 1, the 2, the 3 standard deviation moves that have become relatively commonplace in the stock market over the past 3 months, and specifically in October of 2018 and early November 2018, I want to sell verticals to protect myself against those large increases and spikes in volatility. Because remember, as option sellers, the only time that we get hurt is when a stock moves 1 to 2 to 3 standard deviations outside its move. I mean, even today, I think today is November 13th, the S&P was up around 22 points and then it closed down. So there was a trading range of when it was hot. I think it traded at its high. It was like up 22 to 24 points, and then it traded all the way down where the S&P at one point was down 10 points. That's a trading range of 32 points. That's 2%. That's a wild swing. In 2017 rather, we barely experienced 2% volatility between the high in the S&P and the low in the S&P. But 2018, recently, that's been commonplace. As a result, I do recommend that you protect yourself with a little bit of portfolio insurance and you sell verticals as opposed to naked options. The last thing, which is extremely, extremely important, is you need to close out your positions early. And actually, a lot of you guys are watching this video and you think that you can do this yourself. But even my students who have taken the course and who are members of my trade alerts, I can tell you that about 20 or 30% of them have not closed out their positions early, even after I've made the trade and specifically encouraged them to close out their positions early. Like even today, I had one of my students text me and say that he's lost a lot of money on Alibaba and Facebook, and I told him that, dude, like we closed out all our Facebook positions after they reported earnings 2 weeks ago. And with Alibaba, we closed out I have 0 position in Alibaba right now because I closed it out when Alibaba was trading at around 152 last week. You have to get in the habit of closing out your positions early. And I know that it sucks because you're thinking about it, you're like, man, do I really want to spend this money to buy this back? And there's a few $100s left in premium and there's a high probability that this is gonna expire worthless, or I just don't want to address this issue right now. But I'm telling you, if you want to be profitable, you have to close out your positions early in this marketplace. And the best way of doing that is to ask yourself and evaluate every single position that you have. Ask yourself, would I make this trade right now? And if the answer is no, you need to either close out the position or manage and roll the position, which is something that I cover extensively in my course in the Best Options Trading course. You can get that at beststockstrategy.com/memberships. If you want to learn everything that you need to know in order to trade options profitably, you can go and purchase that course. But remember, you should ask yourself when you scan all of your positions, would I make the same trade right now? If the answer is no, close it out or roll and manage the position. And yes, it definitely hurts when you close out a position and you make an unnecessary adjustment. In fact, just last week, I closed out a 430 strike price call for BlackRock because BlackRock was trading at around 422, and then I got a little bit too close for comfort, so I closed out the 430 call and I paid $160, around $170 when you factor in commissions, only to see the next 3 days BlackRock fall all the way down to around below 410. And when I thought about that, I was like, damn, I just threw away $170 when I didn't even need to touch that position at all. But you know what? I'm completely okay with that because I'm building good habits and I'm reinforcing good habits, because the decision that I made at that specific moment when I decided to close out that trade, I had all the information available to me at that specific moment when BlackRock was trading at $422, and I thought, hey, I can close out this position for a profit, and I can buy it back for around 40 cents. It'll cost me $170. At that specific moment, I have no idea what the stock's going to do the next day, the following day, and the days prior to it expiring. So at that specific moment, I closed it out, spent $170. Yes, in hindsight, which is always 2020, it turns out that I didn't need to make that trade. But at that specific moment when BlackRock was trading at $422, $423, I made a decision, which is the right decision. It reinforces your positive habits to close out that positions, get risk off the table. And I would say 5 out of 10 times, maybe 4 out of 10 times, you're going to see BlackRock increase in price to around 428, in which case, why do I want to log into my account and get super stressed out and watch that position incessantly to make sure that BlackRock doesn't climb above 430? Like, why do I want to deal with that stress and headache? Just close it out, spend a little money. I already had a gain on that position, and move on to your next position. The other thing is you have to make sure to trade small. Always leave at a minimum 30 to 35% of your account available in buying power. Target around 40 or 45%. So in the event that you have, let's say, a $50,000 account, at an absolute minimum, you should always have at least $15,000 available for you to trade. So your buying power should, with a $50,000 account, it should be at a minimum $15,000, but you should target 45%. So you should target, I don't know what that is, maybe $22,500. You should target to have around 45% of your account available in buying power, which means do not trade too large. And actually, one of my criticisms of trading verticals is that people tend to trade too many contracts because there's a buying power reduction in the vertical that's not that large. But what I see happen sometimes is that the stock will trade down between the upper strike that you sold and the lower strike that you bought, and then you can't manage and roll that position easily because it's a vertical, and then you're going to get stuck. So make sure that, especially when you're trading verticals, that you do not trade too many contracts, because you don't want that stock to fall in no man's land where you're not going to be able to manage that position, and therefore you're going to have to close out that position for a loss. So be very careful of your size. I guess the last thing is you want to make sure that you build good habits. I can instill in you all of my knowledge, and sometimes that doesn't necessarily mean that you're going to be a good trader. You need to practice, and you need to build up positive habits. And I can tell you that you have to make sure that you don't give in to the desire to be greedy. And this is not a knowledge game. You can read all the articles you want on seekingalpha.com. You can take my course, and unless you apply that knowledge, then that will mean that you're going to be a successful trader. But if you watch these videos and you think that you can implement and do everything yourself, I'm telling you that you're just going to cost yourself money. My students, they take the course, they then take the trade alerts, they build up incredible habits which over the past 3 months have saved them tens of thousands of dollars. So if you think that you're just going to be able to watch these videos and do everything yourself, then I hope you're able to do that, because look, no one wants to spend money. Like, if I was in your shoes, I wouldn't want to spend a course. I wouldn't want to spend $349 every single month for alerts. But I'm telling you with absolute certainty that if you think you can just watch all these videos and do it yourself, there's an extremely high probability, probably 80 or 90%, that you are going to cost yourself substantially more money by trying to do everything yourself than you are going to if you simply purchase the course or at a minimum subscribe to the trade alerts. So anyway, I just broke it down for you. My exact strategy that I'm going to use in order to trade profitably for the remainder of 2018 and for 2019, which I believe is going to be a sideways market or even down 5 or 10%. And I'm not holding anything back from you. Nothing. This is exactly the method that I'm going to use. So there, you have it. Now you have this information, you're armed with it, and now it's time for you to do something about it. If you have more questions, or if you want to receive additional training, go to go to beststockstrategy.com, where you can enter in your email and receive $400 worth of free training. To many people, that's worth tens of thousands of dollars. That training is worth more than anyone else's paid material. So I know that some other criminals are selling like $2,000 courses. This $400 training is worth more than their courses. So go to beststockstrategy.com and enter in your email address. Please like, comment, share, and subscribe to this channel. If you have any questions, leave a comment below. I answer everyone's comments, and I appreciate your time, and I'm here to help you.